This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. Okay, well this is the third lecture on chapter 18 of the P4 notes. In the previous lectures I've explained what options are and looked at over-the-counter options. In the second one I explained what the headings in the table mean for traded options. But now let's actually look at an example and see how we use the table. And so the example, it's example 3 on page 99 of the P4 course notes. A UK company owes a US supplier $1 million payable in April. The current spot rate is there, 1.485, 1.487. We are concerned the dollar might strengthen. Options are available at prices as shown in the following table. So there's the table. In fact, it's the same table, I think. Is it? Yes, it's the same table we used in the last lecture. But this time we're actually going to use it. And part A, there are two bits to this. Part A says show how we can actually use traded currency options to hedge the risk at 1.475. So let's set up what options are we going to buy. And this will happen in April. No, it won't. It'll happen now. I'm sorry. The transaction is in April. So as of now, we're going to buy options. We're going to have to pay a premium, but we're going to have to decide, obviously, which of those, however many there are, 18 premiums, is going to be relevant. And what do we need to know? To be able to use the table, we need to know the strike price. Now here the question actually tells us, it says it wants to hedge the risk at 1.475, and so we're going to use that one. There are 3 available, appreciate, and check in the exam. Sometimes they've actually told you which strike price to go for, as this question does. Other times they've expected you to do it for all 3 and show the effect. But if you can do it for one, you can do it for any number. But we're going to go for a strike of 1.475. We also need to know whether we want a call or a put. Well, I said in the last lecture, a call is if you want to buy, put is if you want to sell. The contract currency, the 31,250 at the top of the table, is quoted in pounds. So it's whether we want to buy pounds or sell pounds. Which way round is it? We owe a supplier $1 million, so we'll want to buy dollars, but in order to buy dollars from the bank, we're going to have to sell them pounds. So we want the right to sell pounds at a fixed rate. It'll be a put option. The third thing we need to know is the month. Well, I haven't said here whether they're European or they're American. I said for numbers in the exam it's never mattered. But since we owe money in April, we'll go for an April option. If it's European, it would apply on the last day of April. If it's American, it would be any time up to the last day of April. So putting those 3 together, you better check me here, but an April put at 1.475 from the table, April column under puts, 1.475, from the table it's 1.20. However, before we can actually use that and calculate the actual premium payable, we need to know how much we're getting the option on. You know, we want the option to convert $1 million, but it's got to be in fixed size contracts. You'll be given contract size. We are here, it's 31,250. So we need to know the number of contracts. And watch carefully. Think about the logic, it'll help you remember. How much do we want to have the right to convert? We want to be able to convert $1 million, the transaction. The problem is it has to be in these fixed size contracts of 31,250, but they're pounds. So we need to convert to pounds to be able to work out how many contracts. Well, what exchange rate are we going to use? Think about it. What we're buying is the right to convert at 1.475. We want the right to convert $1 million at that rate. What's the equivalent pounds? We'll convert at the strike. So just for these purposes, we'll convert at strike. Now I'm not going to work that out because whatever pounds that comes to, it's got to be in units of 31,250. So it seems silly to have two calculations when it can be one. But $1 million divided by 1.475 is 678,000 pounds. But divide by 31,250, I get 21.69. However, again, it has to be fixed size contracts. In practice, you can either go up or down. In the exam, go to the nearest. I'll have 22 contracts. Now we can put the whole thing together and work out the total premium payable. From the table, it's 1.2, I did say in the last lecture, it's 1.2 cents for every pound. And so what will it come to? We've got 22 contracts. Each one is 31,250. So again, I'm not going to multiply yet, but that's the total number of pounds we're buying the option on. And the cost, it's 1.2 cents for every pound, or in dollars, 1.2 cents for every pound on which we've got the option, which comes to how much? $8,250, but $8,250, the premiums are quoted in cents. When's that payable? Well, just like over the counter, that's payable immediately. And since we're in the UK, we need to convert it to pounds, but we'll convert, since it's payable immediately, we'll convert at today's spot. So 8,250. We're paying, remember, so we need to buy dollars. The spot rate, the dollar buy rate, 1.4850. And so the premium payable, 5,556. And again, it's payable immediately. Now that was part A of the question, and on many occasions, well, certainly several occasions in the past in the exam, that's all they've wanted. And so if you need to, pause and work back through that. But being able to use the table and working out, being able to state what it is we're buying. We're buying, I'll write down, 22 April put options at 1.475. So be able to state what it is we're buying, be able to use the table and calculate the premium payable. However, although that might be all for the question, he could continue, and we will, and do part B. It says show what will happen if the spot rate in April is 1.41 to 1.412. Well, remember, all we've done at the moment is bought the option. That's all. We've not converted any money. We've paid 5556, and effectively we've got a piece of paper entitling us to convert at 1.475 or whatever. It's in April that we make the decision. And in April, remember, we have the choice. We either convert at spot, the spot there, 1.41 to 1.412. If we want to do that, fine, we throw away the option. Or we exercise the option and the option rate was 1.47, was it 1.475? So it's our choice. Here, which way round? We're buying dollars, we're paying dollars, so we need to buy dollars. Surely, since we're buying dollars, the higher the rate, the better. We are better to exercise the option. We will exercise option. Now, there are two ways you can show this. What you can do is effectively convert at 1.475, a bit like an over-the-counter one. The only thing is, of course, you can't convert the $1 million. It has to be in the fixed size contracts. However, the other way, the better way, the way it actually works in real life, and the way, or a similar way to the way interest options, rate options have to work, is the way I'm going to show you. So I'm going to show you what's the best way and strictly the right way. If you want, look at the answers in the course notes, you'll see an alternative way which would come to the same conclusion. But what happens is this. First of all, whatever happened to spot, the transaction itself will convert at spot. For the moment, forget the option. Convert the transaction at spot. And so what will it be? It was $1 million. We're paying dollars, so we're buying dollars. It's the dollar buy rate. It's 1.41. And that converts to $709.220. Now then, if the spot rate was better than option rate, that would be the end of it. You'd throw away the option and that would be it. However, here we have the option to convert at 1.475, which is better. And so the way strictly it works is this. We exercise the option. But it's, again, a bit like insurance. In a sense, we claim off the dealer. In that we have the right to convert at 1.475. At the moment, we've had to convert at 1.41. Well, we effectively claim back from the dealer the difference. It's my words, it's not the right words, but we'll claim, in a sense, the difference. And what we do is this. How much did we have the right on? It was 22 contracts. Each with a size of 31,250. So that meant how much money I had the right to convert at the fixed rate. We had the right to convert at 1.475. Spot rate is 1.41. We claim back the difference. We converted the transaction to spot. We claim back from the dealer the difference between the strike price, the option rate, and the spot. And that comes to how much? We're claiming back what? 6.5 cents, I think. 0.065 times 31,250 times 22. 44687.5. But what currency is that? It's dollars. Think about it. The difference between the strike price and the spot rate is 6.5 cents. So we're claiming back 6.5 cents on every pound. It's in dollars, so we need to convert to pounds. What rate are we going to convert at? Well, remember, this only happens in April, the date of the transaction, and so we'll convert at the April spot. We're receiving money, we're claiming this back, so we'll be selling dollars. It's the dollar sell rate. The spot rate at the date of the transaction. Which converts to pounds to how much? 44,687.5 divided by 1.4120. I get 31,648, and that's a receipt. I better just check that. 44,687.5 divided by 1.412. Yes. And so the net payment, we paid out 709,220. We get back 31,648, a net payment of 677,572. That takes place in April. But like before when we had over-the-counter ones, remember there's always the premium payable, whether or not we exercise it, and the premium we worked out earlier, 55556. But do make the point that although the 677,000 isn't until April, the date of the transaction, the premium, that was payable immediately. Do make the point. But I did say the examiner generally wants to show the net result. The total payment ends up at 631,128. And there we are. Now again, I hope that made sense. A couple of final points to make though. One is, I did say there is an alternative way of showing it. And certainly the old examiner, some of his answers did it this way, some did the alternative way. It didn't matter, he would accept both. But what I've shown you is strictly the correct way. But if you want to look at the other way, it's in the answers at the back. A very small point, but it may occur to you, could get you a little bonus mark. If you look at what we did here, we converted the transaction at spot, but because we were paying money, it was the dollar buy rate, 1.41. When we claimed off the option, we received dollars, and because we received, we had to sell them, and we converted at 1.412. Well, there's no need to change yours for the exam, but if you spotted it, just might get you a little bonus. Instead of converting the two separately, what you could have done is take that dollar receipt. I'm trying to find a different colour. There we are. Take that dollar receipt of $44,000, used it to pay part of the million, and then converted the rest of the million at 1.41. Now, it's a tiny point, so don't worry about it, but if you did try that, you would find you were a tiny bit better off, because effectively the 44,000 would be converted at 1.41 instead of 1.412. So it's a small point. I'll say there's no need to do that in the exam. What I've done there is fine. Finally, something else you've never ever had to do, and I doubt you would, but be aware of. I said earlier that there are two types of options, European and American. And because European can only be exercised at the end of a month, they're a bit more limiting. You know, if these were European options, what we've done there is fine if it's the end of April. But what about if the transaction was the 10th of April? Well, in fact, it's not as limiting as it sounds. Because even if the European, what you would do is this. Whatever the date is, convert the transaction at spot. If it's not end of April, you can't actually exercise the option. But what you would do is this. You'd sell the option. Because these options are traded. And that table you've got, they're the prices today. But, you know, every day the prices stand to change when it comes to 10th of April or whatever. If it was European, you can't exercise. You'd sell the option. And you'd look at from the table what the premiums were on 10th of April. And your receipt, that'd be 22 times 31,250 times the premium on the date of the transaction. So European aren't actually as limiting as they look. Now, you've never had to do that. Never. I doubt you ever would, because he'd have to give you two tables in the exam. The arithmetic, I hope I'm not confusing, the arithmetic I showed, the black figures, is all you're ever likely to need. But if you've got the chance, do be prepared to make the point that because they're traded options, you don't have to wait till an exercise date. You can sell the option.